Hi, everyone, and welcome back to the Simplify Senior Transitions podcast. I'm Dale Corpus, a senior transition specialist and real estate expert based in the San Francisco Bay Area. I'm also part of the sandwich generation, juggling care for aging parents while raising my own family. So I know firsthand how overwhelming senior care decisions can feel. This podcast is all about making senior living conversations easier. We feature expert guests to help families like yours navigate real estate, caregiving, placement, and everything in between. Today's guest is someone who brings a fresh and empowering approach to senior finance. Mark Maimon is a mortgage branch manager at Luminate Bank and the host of the On the Mark podcast. With over $2 billion in funded loans and 2 decades of experience, Mark helps families unlock financial strategies many don't even know exist. He specializes in bridge loans and other creative lending solutions for seniors who need to transition homes, but don't want to be pressured into selling quickly or tapping into reverse mortgages. His insights today might save you tens of thousands of dollars and a whole lot of stress. Let's dive in.
Welcome to the Simplify Senior Transitions podcast, where we help families navigate senior living, real estate, and everything in between. Hosted by Senior Transition Specialist Dale Corpus, this show brings you expert insights, real solutions, and stress-free strategies to make senior transitions simple. Ready to dive in? Let's go.
And we're back, everybody. Mark, welcome to the show today. How are you?
Thank you, Dale. I'm doing great. Thank you. Nice to see you.
Oh, likewise. Now, let's just jump right into this. Can you just start by sharing a bit of your story?
Yeah, absolutely. So I've been in the mortgage industry almost 25 years. I'm in my 24th year right now. And I've done traditional residential mortgages that entire time. And I ran a national bridge loan program for about 5 years. And the way that I got into the senior space was actually through that program, seeing that seniors were needing those types of products and moving forward with them more regularly. So it was kind of not necessarily even by design, but just observing the type of business that we were getting was super helpful. And basically what we found was that seniors were just in these situations often where they needed to move first and sell later. So that was something that our bridge loan program was able to accommodate. And from there, we expanded it, started to see all the different holes in the financing that seniors needed for various reasons and the challenges that they typically had to be able to qualify. And that's why we've curated now a full suite of products that handles senior needs at every different stage of their aging.
Excellent. Now, I also know you have a podcast. How did you end up launching that podcast, and tell people what it's about?
Yeah, sure. So it's called On the Mark. It has a few different topics that we focus on. Lately, especially over the last 6 to 12 months, it's been heavily focused on senior needs and senior issues. So we interview thought leaders in the industry in various parts of the senior space. I'm also a big proponent of financial literacy in general, and I think there's a huge gap there where oftentimes, and we can kind of tell when a client is faking it till they make it, so to speak, and they want to seem like they know what they're talking about. And sometimes they do, or they know certain components, but there's just a big gap in that type of knowledge. So we do a lot of financial literacy. You know, one of my favorite sessions was about how to choose a financial advisor and what the different types are, that you don't need to have millions of dollars in order to have a financial advisor. You can hire somebody to just give you general advice by the hour, potentially.
Yeah.
So it's senior needs and financing. It's general real estate, awareness and financial literacy. And then another passion of mine is real estate investing. So we create a little section of it that's called creating a side hustle in real estate for people that have another job. They're not doing real estate for a living per se, but they want to build wealth over time.
Yeah, I like it. We have a lot of things in common. My first podcast was called The School of Cash Flow, and I am a real estate investor myself. I used to interview a lot of full-time real estate investors as well. But hey,
It's great.
so we both work with seniors. So I know why I started working with them, but I want to learn more about you. What inspired your passion for helping seniors and their families specifically?
Well, it started with just seeing the need and realizing that the community had really limited options. And that I didn't like that. And I'm a problem solver by
Yeah.
design, just wired that way. So when I see a problem, I try to fix it, or a need, and try to fulfill it. So it came partly out of just watching my business develop over time through all these bridge loans that we were doing and seeing the demographics of the people that were taking those types of loans. But then I'm also, as you mentioned in your intro, I'm also in that same sandwich generation. So I'm dealing with challenges with my own parents, even right now. I'm in Southern California, they're in Seattle. So we have distance between
Yeah.
us. And my brother's actually in the Bay Area as well. So neither of us are close to our family. So we're dealing with, health challenges and things that come up unexpectedly. And gosh, are we really prepared for what might happen if one of them, isn't there one day? How do we deal with that? One of them pays the bills, the other one doesn't even know what the account numbers are, let alone how to get access to them. So we kind of fix some of those logistical things, but I'm passionate even more so now because I'm going through it and I'm seeing the challenges and trying my best. We talk about planning a lot with the families that we work with. I'm trying to, do that for my own family as well and get us prepared and do so at a time when things are generally okay. Because if you wait until a crisis moment, boy, is it 1,000 times harder. So try to prepare them financially and just make sure that their ducks are in a row, so to speak, so that if and when anything were to happen to one of them, we have a plan on what to do and how to pay for whatever that plan is.
Got you. Now, I have a question for you just because I want to know the answer.
Sure.
You funded over $2 billion in loans. What's the biggest lesson along the way?
Oh, geez. There's so many of them. Um, is the question more in relation to building a business or just as far as like what clients are looking for?
Kind of however you want to go with it.
Okay. Well, I would say I always try to be a resource. I never feel like I'm selling anything to anyone. I'm also by design an educator. That's partly why I created the podcast. We've created a whole set of educational resources. Again, because I saw a need for it. And I think a lot of people are making decisions that are misguided or have no real basis for them other than preconceived notions. And that always bothered me when people make decisions in a vacuum and they don't really understand the implications. And, they do things where they ignore the tax implications of a certain step that they're taking. And then they're making bad decisions because of lack of information.
Yeah.
So for me, I approach my business from a place of service and education. And I think naturally people gravitate to that because they don't feel like you're the stereotypical sleazy salesperson who's just trying to make a buck. I feel strongly that I need to be a resource for people and that I need to educate myself on all of these important components to finance and personal finance, even if they're not directly related to mortgages. If you don't have that perspective, you can't really add as much value as you should. So I'm trying to raise the bar in my industry. It's very unfortunate that my industry has become a very low bar as far as where it's just, online mortgages and things like that. I really try to work with people that value and appreciate advice because that's how we approach things.
Okay, perfect. So obviously you're in the mortgage industry. A lot of people that are listening may not be familiar with real estate finance.
Mm-hmm.
I myself started in the mortgage industry in 2001 before I became a realtor. So you mentioned the term bridge loan. I know what it is, but for folks that aren't familiar, what's a bridge loan and how does it work?
Sure. So bridge loan is designed to be short-term financing to bridge the point of time when you buy and then sell. So most people think if you're upgrading a home, you sell your home first and then you buy something after because you need all that money for the down payment. But the problem is logistically, especially in an ultra competitive market like the Bay Area, which is as competitive as it gets. And we're licensed in all 50 states. So I've seen things in other states. nothing compares to the speed and intensity of the Bay Area market. I'm sure you can attest to that.
I can attest to that.
Right. So try going in and making an offer that's contingent upon selling in a bidding war. It's just not going to work.
Those get
So-
pushed aside.
Yes, exactly. It's like the scarlet letter. Even if it's a
Right.
great offer, most of the time sellers are not so interested in waiting for you to sell.
Right.
So these products are designed to allow you to buy first, get settled in as much as you need or want, and then be able to sell after. And that provides some benefits as far as, you're not living in the home anymore. So showings become easier. You can do renovations that might be difficult to do while you live there. The example I always use is if you want to refinish the floors, but you've got 4 kids and a dog, you can't live there during refinishing of floors, but that might be an important factor to a new buyer. So if you're
Okay.
out of the home, you can do the renovation that you need to really make the property look great and be show ready. And showings are easier. You could do it, without having to coordinate schedules for soccer practice and things like that. So the idea behind it is the financing you use to take out equity from your current residence in
Mhm.
order to fund the down payment on the new property before you've sold your current residence. So it's bridging the gap of time, allowing you to buy first and then sell after.
Okay. Now, how are seniors using bridge loans to fund a move to senior living before selling their homes?
Right. So oftentimes these situations come up with senior living in a crisis mode.
Okay.
So people need to pull out equity. If we're looking at senior housing and all the different types, you have CCRC communities, continuing care retirement communities, that typically have a pretty substantial entry fee
Right.
that people need to pay. And that money is oftentimes the current generation tends to be house rich. I wouldn't say cash poor, but their main asset is their home.
Right.
So oftentimes people will need to pull out the equity from their current home to be able to pay the entry fee. And sometimes there are long waiting lists for the top communities. So you don't know when your quote unquote number is going to get called per se, and you have to be able to move quickly. So it can be used to fund an entry fee. Sometimes people need to move into, let's say, assisted living or memory care, and they need short-term financing because those are, $10,000 to $20,000 a month.
Right.
And if your home isn't ready to sell, or your family's not quite sure, not on the same page as to whether they want to sell or when to sell, you might need $50,000 to $100,000 just to bridge the gap of time to be able to get into the new community that you're moving into. So, and seniors, I think the reason why we saw through our bridge loan program that seniors were more apt to take bridge financing is that if you compare them, let's say on the other side of the spectrum, to a young bachelor or bachelorette that's trying to change to a new home, the bachelor or bachelorette might go live with their parents. They might stay at a friend's house for a few months if they sell first. But a senior really needs to settle into their new home. They're not going to couch surf, right, for a few months while they wait for their CCRC community to put them at the front of the list. So there's a more significant need for seniors to be able to settle first, which means come up with the cash to be able to settle either in a CCRC or assisted living, memory care type of situation, settle in, and then deal with the house because it's emotional.
Right.
The move is emotional. And then there's also the emotional attachment to the home itself that they're leaving. So sometimes that's just emotionally too stressful for a family that's going through a lot to be able to do both at the same time and time them up just perfectly.
Right. Now, what are some of the risks or challenges families need to know about before committing to a bridge loan?
Sure. So the common misconception is that bridge loans are designed to be short-term financing, usually 12 months or less. It doesn't have to be. There are some programs that you can carry the loan as long as you need to. But what the common misconception is that if you only need a loan for a short period of time, it should be less expensive to get it. And it's actually the opposite. Because if you look at it from a lender's perspective, let's say you're taking a $500,000 bridge loan and you only need it for a month. Right? If they're not charging you fees, really, they're putting $500,000 at risk for 1 month of interest. Not really all that attractive to a lender. So what usually happens is there are points or origination fees involved in bridge loans that can add to the cost of what it would be if you were comparing that to a conventional loan. So there's a little bit of a misconception there that we inform people about upfront. The shorter term you need the loan, the more expensive it is. It's not the opposite. So it's a little counterintuitive. But the main risk is that you have to make payments. In some cases, we actually have some programs that don't require payments for 6 months and they just add the interest to the balance. But most of them have a payment associated with them. So when we're working with the family, we're looking at, okay, how long do we anticipate you're going to need this bridge loan? And we actually include on the amount that we're cashing out for them, the number of months or years, usually months, that they anticipate needing to pay that mortgage. So we're actually including the mortgage payments in the loan amount so that they have cash on hand to make the payments during that period of time. The risk is that, let's say the home doesn't sell, the market shifts dramatically, which doesn't really happen in a matter of 2 or 3 months, but the market shifts, or for whatever reason, the home can't sell, or there's a natural disaster, and now you're carrying this mortgage for a period of time when you were planning to sell it, but you have to be prepared for what happens if you don't sell it for as much as you want or as fast as you want. But that's really the primary risk, is that you're paying for this mortgage until you pay it off. In some case, usually means selling, but you have to make the payments in the meantime until you sell it or otherwise dispose of the loan.
Okay. Are you able to give an example just like of how much equity you could tap into? For example, say a house was worth $1 million and say that the senior had, I don't know, maybe $600,000 loan on it. Can that person still get a bridge loan?
Yes. Usually what we try to do in that case is do a second lien bridge loan, because ideally we don't want to have to pay off that $600,000 loan. And in all likelihood, that loan is at a lower rate than what it would be if you replace that loan. Plus, the fees are a function of the loan amount. So if you're paying off that $600,000 with the bridge loan, you're paying fees on the entire amount that you borrow.
Right.
So ideally, we do a second lien bridge in that case. Not always possible depending on the circumstances, but that would be the ideal goal. So leverage can go anywhere up to potentially 90 to 95% of the value of the home. So in that case, you could get, let's say, an extreme example, which I generally don't recommend, because if you're financing 95%, you won't have enough left over to pay Dale to sell the home and pay the transfer. Like, you'd actually have to write a check when you close on the sale of your home. So you don't want to do that. Let's say you go to 90%, even though you might be able to do 95. So then you would get basically a $300,000 bridge loan that would leave your $600,000 loan in place for a total of $900,000 of financing secured by the house. $300,000 of that would be the bridge piece.
Okay, perfect. Thank you for explaining that. That paints a really clear picture. Now, what alternatives to bridge loans do you recommend, if any, and how do they compare?
Well, there aren't a lot of financing solutions beyond that. There's different ways to structure bridge financing. So the example we just went through is what we call a departing residence bridge. There are also products that allow you to just put a small amount down on a new property. Makes your offer a little less strong. I would imagine you've experienced that if you're coming in with 5% down versus 50% down. There's a difference in the perception of how strong your offer is. But there are some solutions that will allow you to finance up to 95% of the property you're purchasing, knowing that when you sell your departing residence, you're going to put the majority of those proceeds, if not all of them, into paying down the loan. So there are some other types of bridge loans beyond the one that we originally discussed that could be a viable solution. But people often think, oh, I should just open a HELOC. But the problem is, what people don't understand is that when you open a HELOC on a property, one of the closing documents that you won't even see until you get to the very end of the process basically says your intent is to occupy this property as your primary residence for the next 12 months. It's called an occupancy affidavit. That's like the standard term. So if you're about to list your home for sale and you go out and you get a HELOC and you sign that document knowing that your intent is not to keep the property and pay the interest for 12 months, you basically just committed mortgage fraud. Right? You're signing a document you know is incorrect. You know the lender would not give you that loan if they knew you were going to immediately list your home for sale, and you could get yourself into a serious bind in that case if the lender really wants to pursue it, or wants to, charge you extra fees or something that you should have paid had they known it was a bridge loan, that can create a problem. I've also seen situations where people tried to do that and then they went to apply for the mortgage, and the lender for the new mortgage on the property that they were purchasing asked to see the closing documents on the recently closed HELOC, and it said primary residence. And so the lender on the purchase side said, wait a second, you can't have both of these be a primary residence. You were clearly either lying on our application or theirs. We're canceling your loan. We're denying your loan for the potential of fraud. So you have to be careful. You can't get sneaky with that, even though a traditional HELOC would be a better option as far as fees and potentially interest rates. You can't mess around with that because it could actually affect your purchase financing in a way that you might not anticipate. So HELOCs are really the only other way. If you prepare in advance, which I'm a huge proponent of, let's say you're thinking, I want to buy in a year or 2 years, open a HELOC. There's really no downside to doing that. You're just gaining access to the equity of your home in advance, and it's totally legitimate. You could say, you could sign that document with confidence and then use it a year or two later and have no issues whatsoever. But you have to prepare in advance, and oftentimes people aren't doing that.
No, agreed. I mean, even for folks that are non-seniors, it's like I have folks that wish they had HELOCs that they could tap into when they get laid off, but they can't even qualify for a HELOC because they have no income. So it's just one of those things. I always think a HELOC is also just one of those emergency funds. If you just plan in advance, it was already there. You know what I mean?
It is.
Yeah.
Yeah. It's in many cases, people have owned their homes for a while. It's like found money. It's like playing with the house's money, so to speak. I mean, you want to take it seriously because it's a mortgage that you will have to repay.
Yeah.
But even if you bought your home and put, let's say, 20% down, and then it's appreciated over the next 5 years, it's not a bad idea to tap into it, because a line of credit works kind of like a credit card.
Right.
You only pay for what you use. So if you open it up, you have access to the equity, but you're not making interest payments on it if you haven't actually used the money. So that's why it's a great product for consumers. I think it's honestly a terrible product for banks to offer, because they have to keep all this capital on hand in case you come and ask them for $500,000 tomorrow, but you don't have to pay them anything in interest if you don't actually take it.
Yeah.
So
now I want to weave in the topic of reverse mortgages into this conversation.
Sure.
I know you're not the biggest fan of reverse mortgages. Can you share why you take that stance?
Yeah, there's a lot of reasons. And in full disclosure, there are a couple of circumstances where it may be the only option or the only good option. Usually that has to deal with memory care challenges where somebody can't sign on their own behalf. Reverse mortgages are more accommodating of other people that have POA to sign on behalf of the senior to be able to sign on the loan. Conventional lending is very nervous about doing that because of the prevalence of equity theft, where people sign on a loan for somebody, a family member that doesn't have mental capacity. They don't even know it's happening. And now all of a sudden somebody's stealing the equity of their home and using it for their own purposes. So that's an area where a reverse mortgage might be a better solution if you have memory care issues where the person can't sign on their own behalf. But as far as the downside, so my biggest beef with it, so to speak, is the compounding loss of equity, which basically means the best thing about a reverse mortgage is that you don't have to make an out-of-pocket monthly payment every month. The worst thing about reverse mortgage is that you don't have to make an out-of-pocket payment every month, because what's happening is you're accruing interest. The first month you have that loan, you don't have to make the payment, right? You've accrued some interest. The next month, you're paying interest for that month and the prior month. You're paying interest on interest. And as you go further into the loan, it's compounding out of your favor, meaning you're paying interest on interest you didn't pay a year ago, 5 years ago, 10 years ago. And so what's happening is you're losing equity faster and faster the longer you're in that loan. It's the opposite of why people invest money in stocks and other investments. They want it to compound in their favor and grow exponentially to benefit them. The loss of compounding equity when you're not making a payment actually compounds against you, and you lose equity faster. So that's my biggest issue with it. The closing costs and interest rates are also very high. At the moment, reverse mortgages are probably in the 9s on average. So that's not ideal. The most common one is one called a HICM mortgage, which is an FHA loan that has pretty substantial closing costs. They don't allow you to move out of the property and still maintain the loan. So let's say 5 years from now, a senior needs to move into assisted living. They basically have 6 months or so to pay off that loan. And what if they're not prepared to sell the home? What if they don't want to sell the home? They have to find some other way to pay off that lien because there's a requirement to continue living there as long as you maintain that mortgage. So it gives you lack of flexibility, and sometimes that forces your hand to sell a property when you might not want to. So it's just lack of flexibility, high costs, the loss of compounding equity. For me, it tends to be a last resort option for a client. Because there are other alternatives that we've, curated this whole suite of products to be able to allow people to at least choose from other options that might be a little bit more attractive.
Excellent. Now, what are the most common misconceptions families have about reverse mortgages?
It's just that it's the only option. Because people think, well, I don't have income anymore. I have limited income, from Social Security, let's say. So I can't qualify for a mortgage. And that used to be true, that reverse mortgage may have been the only option, but our industry has evolved quite a bit in creating more creative products that are not necessarily driven by income. So it could be driven by assets that you have invested that you just don't want to use. It could be just based on the equity that you have in the home. There's lots of different factors that we can approve loans on these days. But that's the biggest issue, is that people don't know that these alternatives exist because, that's why we're doing this podcast, is to raise awareness. There are not very many people in the mortgage space that are focused on this specifically. So it's just not out there that there's that information. So that's why I commend you and appreciate the opportunity to come onto your show today and talk about it, because there are other options. And in many cases, they're better options, and they give the family a lot more flexibility to do what they need to do to care for the senior and to also potentially deal with the legacy concerns where they may have told their grandkids, oh, I'm going to give you my house. When I'm gone, you're going to get my house. Well, if you take a reverse mortgage and then you need to move into assisted living that you hadn't planned on because you have some sort of crisis, you can't do that. Yeah. You can't. You have to pay off that loan, and that usually means people are in a situation where the family has to sell it. So there's a lot of impacts there.
Yeah. So related to what we're just talking about right now, then what specific alternatives to reverse mortgages do you feel are safer, more strategic, or more flexible?
Sure. So one of my favorite ones is a creative niche with a line of credit, a home equity line of credit. So if you or I, Dale, went to apply for a line of credit, the first question out of an underwriter's mind or list of questions is, what's your income? Right. So, they would look at our tax returns, they would look at all the standard stuff and say, yes, you do, or no, you don't qualify. One of the unique niches that we have with a HELOC product in particular is one where we can convert, just on paper for the sake of the loan application, convert retirement assets into additional income. And if we have time, I can give you an example of how we did this. It was actually
You can. Yeah.
Okay, sounds good. There's actually a client who was trying to avoid a reverse mortgage at the recommendation of their financial advisor for all the reasons that I mentioned. They really didn't want her to do it, but she had been denied for a few HELOCs already. So this particular program, the reason we were able to close it is because we converted her. She had around $350,000 in an IRA that she didn't want to touch because she would need that for care. So it wasn't like she could just liquidate that instead of borrowing against her home. But she didn't need money right away. She just wanted access to prepare in advance. This is why you hire a financial advisor. They help you prepare in advance, and rightfully so. So in this case, what we did is we converted those assets into additional qualifying income on the HELOC application. Because of this little niche that we have with that program, that $350,000 turned into an extra $10,000 a month of income on the application. Made all the difference in the world for her to get approved for that HELOC. So that's one example of some of the unique niches. We had another client also trying to avoid a reverse mortgage who thought she was either going to have to take it or sell her home, which she really didn't want to do. We have a program that doesn't require a statement of employment or income. it's really probably originally designed for people who are in between jobs, or they just started their own company or something like that, where they can't get conventional financing. But if you think about it, the biggest issue for seniors is the income and
Yeah.
employment, right? So it's an application of a product that maybe isn't designed with seniors in mind, but the rates are better than a reverse mortgage, and you don't have the compounding loss of equity. So it's another potential solution that could be right for a family in certain circumstances, depending on their needs. We look at all these different products to see, first of all, which ones they'll qualify for based on their financial profile, credit profile, if they need money short-term or long-term to, pay for care at home or in assisted living, if they don't want to sell their home. There's lots of different products that we have. These are just a couple of examples, but the common thread through all of them is that they're not driven by traditional income like a conventional loan might be.
Yeah. So what I'm hearing is like you're able to derive an income off somebody's portfolio, like, because they come from banking as well. Like this is a form of asset dissipation, right?
Correct.
Yeah.
Yeah.
That's
So what
awesome.
they do is they look at, okay, if you were to deplete those over the course of X number of years, how much income would that give you theoretically? You don't actually have to do it. It's theoretically, and that's the basis for why they add the additional income there.
Perfect. Switching topics a little bit. Let's talk about, I know that many adult children, they struggle with financial decisions on behalf of their parents. What advice do you have for navigating those conversations?
Do them early before you're in a crisis moment, because the options you have when you need to move quickly, and maybe the senior's not going to be able to live in the home anymore, or they just haven't prepared in advance. The HELOC example I gave earlier, where if somebody had done it a year prior, they would have no issue using that HELOC for whatever they need. The preparation in advance is so important. So, and this is what I went through with my family. I have kind of a, I guess, traditional family where one person handles the bills. They're just the bills person and the accounts person and the money person. And the other one doesn't even know how to get in, doesn't even have a login to the accounts to see if there's any money in the accounts or what's being paid or not paid. So we had a family meeting where we went through all of the financial information and just organized it on a spreadsheet. The life insurance, the asset accounts, who do we call? Who's the accountant? My dad recently retired. Who are the business accountants versus the personal accounts? Who would we need to get in touch with for any of these things? Get it all on one spreadsheet and organize. And I can't tell you how much peace of mind it gave to my parents. Fortunately, the health scare is much better now. So it wasn't, we were preparing in advance. But if you have a crisis moment, somebody has a stroke, for example, they can't communicate these things to you. So you need to get that information from them while they're still healthy. And that's partly what a financial advisor can do. But as a family, even if you have a financial advisor, which my parents fortunately do, they're not engaged in the life the same way that my brother and I are, for example. They don't know that one of them handles the money, the other one literally doesn't know how to get into the account.
Yeah.
So just preparing in advance, that was a tremendously helpful experience of going through that. And now my brother and I have some awareness of what their situation is. And it basically just confirmed that they're going to be okay. And that was very reassuring for them. They're not going to live in the lap of luxury every day for the rest of their lives, but they're going to be fine. And then we had a meeting with their financial advisor, which reinforced it, and we made some changes and got some insight and did some different things. But it was a very useful experience. But the key here is prepare in advance.
Yeah.
Don't wait for a crisis moment, because your financing options and your options just for life decisions in general become more panicked, more expensive, and sometimes you just won't be able to get them.
Yeah. So in working with seniors, I'm sure you found out that a lot of times you're working with the entire family, all the
Yes.
adult children. So how do you approach helping a client that has multiple adult children involved, each with different opinions or concerns?
What we try to do is encourage the family to pick one spokesperson.
Okay.
Let them coordinate their conversations privately. Doesn't always work.
Yeah.
Because family dynamics are challenging, and sometimes people second guess and they say, well, I have a say in this too. So it can, creep back in. But the ideal scenario is you pick one family spokesperson on behalf of the senior, and we're engaging with the senior and the one family representative. When there are multiple people, it's fine. It's not like we can't work with that. We certainly do that all the time. But sometimes there's second guessing happening. It can slow things down because there's not a consensus on what needs to happen, or they may be uncomfortable saying certain things with the lender, well, mom and dad promised me this, so I don't want them to take a loan because I'm going to get that house someday. And so family dynamics are a real challenge. And when you're adding potential debt to that situation, that can stir up all sorts of emotions for different people. So the best execution, which doesn't always happen, probably only about half the time, is for the family to choose one representative of the adult children. The other challenge we have oftentimes with seniors is using technology, because the mortgage process is a little bit more technologically advanced. It's not don't fax me a bunch of documents and, or drop off a stack 2 inches thick of documents at our office. We can if you need to, but sometimes we need the adult children to just participate, just to deal with very basic technological tasks.
Yeah. Now, do you often collaborate with financial advisors, realtors, or senior care professionals when helping a family put a plan together?
All of the above.
Yeah.
We are huge proponents, and that's partly part of my podcast. You'll see a common thread there. We are big proponents of people having a full, proper financial team. We've had all sorts of examples of things that we've heard in meetings with placement advisors and real estate people and others that support seniors, where people made just horrible decisions that, had they talked to any accountant or any financial advisor, these issues would have been called out and they could have made much better decisions. So when we tell a senior, for example, imagine we're telling a senior, you should take out $500,000 loan in a vacuum without knowing what their long-term plan is, without engaging with their financial advisor. We're giving advice in a vacuum. We would never want to do that. So if we're putting, let's say, $500,000 into a family's hands to pay for care, we would strongly recommend that, first of all, they invest that money in the meantime so that they can help it grow and offset the cost of interest over time. It helps stretch that money out. But we can tell you what financing you can get. What a financial advisor will help you do is figure out over time, if you invest it at certain rates of return and different types of investments, for example, how much longer will that money last? And is that long enough? Is it not? So they're kind of looking at things more from the helicopter view. And I look at mortgages as one piece of a financial plan, but you need the people who are focused on the bigger picture. You need to understand the tax implications, which people always underestimate, especially when it comes to capital gains tax. So strong financial team all around is really critical, especially as you age and you start to get into capital gains tax, estate tax, all these things that get much more complicated. You need those advisors to make sure that you're making the right decisions.
Yeah, well said. Now, are there any predatory lending practices or scams seniors and their families should be especially cautious of right now?
I mean, seniors are always a target for scams, whether it be someone calling from Microsoft saying they found something on your computer that they need to log into your computer because they're monitoring your computer for issues, which is one that I heard about recently. But I wouldn't say it's necessarily scams, other than the equity theft piece. You have to be really careful with that. You need to make sure your estate plan is set up properly so that people that you actually trust and want to have signing authority on your behalf are actually designated with that signing authority. Another estate planning attorney is a critical person in this process, especially if you don't want to end up in probate or with a major tax bill from an estate tax. You want that money to go to your family, not to the IRS. But when it comes to lending in particular, the equity theft is the first one. The second one is not, I don't even know if I'd call it predatory. I would just say it's more aggressive. So there's a big push for reverse mortgages. There's a lot of marketing behind it, very slick, savvy marketing. And I think when people they're not fully informed, they don't know that there are other options. They think this is the only option. And sometimes there may be people in my industry who don't know about the options themselves, or maybe they don't want to present them because they don't offer those types of loans. So you just want to make sure, and this is not a knock on reverse mortgage people, because I work with a lot of them who refer me clients when they can't accommodate, somebody needs a bridge loan or somebody wants to move out of the house in 6 months. It's not the right solution. But you want to be careful because there are good ones who will always put the client's best interest in it first, even if it means that they shouldn't take a reverse mortgage. But what you want to be careful of is the ones that are not going to behave that way. And that could be on the reverse side or any side of mortgages where people are pushing you to refinance when it doesn't make sense or take a bridge loan when it doesn't make sense. You really need to make sure that you're comfortable with what you're getting, number one, and that you're educated on what the alternatives are so you can assess all the different options.
Yeah. What are some red flags people should look out for when choosing a mortgage broker or lender?
Well, understanding the nuances of taxation, huge deal. Estate planning, if they're telling you to take out a mortgage without advising a financial advisor or at least a family member who's very well versed in these things, that's a problem for me. We try to do what we call a higher level of lending, where we're looking at this from a financial planning lens or through a financial planning lens. If you just do loans in a vacuum, you're not really adding much value, in my opinion. And there are big implications of estate planning, ending up in probate or having debt that now you burden your family with, or maybe, I don't know, something else with your financial plan that you're not engaged properly with. Really, again, that's so critical to have that financial team. So you just want to make sure that you've got all the proper advisors in place who can help you navigate this and make sure that it is the right decision to take out a certain type of loan.
Yeah. Now, what questions should families be asking to make sure they're working with someone reputable and transparent?
I think it's a feel, right? So if you're talking to somebody and they're just pushing a product, forcing, encouraging you to sign, that's usually an indication that they don't want you to know that there may be another option. They want to make a sale. When you're working with seniors and their families, it's not a fast decision process. There are so many implications and considerations and opinions, as you alluded to earlier, of adult children. So you should feel rushed unless you are intentionally rushing the process because there's a crisis moment where you need money quickly. And even then you should make calls and see. But I mean, if you look, for example, at our podcast, we're talking about all these issues that aren't really about mortgages per se. They're about what the implications of that mortgage are. And I think if you talk to somebody and they say, listen, I'm going to advise you and I'll give you my opinion, but you shouldn't feel obligated to do anything whatsoever, that's an indication of somebody that is probably a little more mature in their business and isn't desperate to just make a sale. So I think it's a vibe, it's a feel. You can tell if somebody's educating people about all these different components like we do. That's the purpose of the podcast, that we come from a place of service. But sometimes you don't know and you just have to get a gut feel on it.
Yeah. What do you love most about the work you do?
Well, when it comes to seniors, it's the impact that we can have on, honestly, their entire lives. Like we can make it potentially possible to, for example, find a way to pay for the level of care that people want. So let's say they're going into assisted living and they're considering one community is $10,000 a month and the other is $12,000 a month. And they're saying, oh, I can't afford it. Well, with financing your current home, you might be able to. So you can have an impact on the level of care that they have. Sometimes our loans are used to avoid capital gains tax, where we benefit from the step up in basis, which we can get into if you'd like. But it basically means you're able to avoid capital gains tax if you sell the property after the person passes away rather than before. And we can have a huge impact. We had, I think I gave the example earlier about a client who wrote $1 million check to the IRS. Had they contacted us, that $1 million could have gone to their grandkids' education, vacations, all sorts of things that would have made the family, very appreciative and live a better life in theory. And maybe not have to take loans for college. Like it's just the work we do with seniors is very impactful. Because it's not just about the senior. It's about the legacy that they leave to potentially many future generations. Because I'm the beneficiary to a degree. I mean, not directly, but indirectly. of a real estate decision that my grandfather made that is now in the family, so to speak. He died 35 years ago, and that property is now benefiting family members that he never met. So you can kind of see like the impact you can have and the legacy you can leave behind when you make the right decisions. If you make poor decisions or uninformed decisions because you're not getting the proper advice, that's where you run into problems. And the IRS isn't going to return a check to you right after you've paid rightful taxes and you made a bad decision. They're not going to be like, oh, okay, we'll just give you this money back and you can change things around. That's not how it works. So making those good decisions is really critical up front.
Got it. So one of my last questions is this: what's one client story or transformation that sticks with you?
Well, we've kind of touched on a couple of them, but another one that we did was a bridge loan for a couple. One of them was already living in an assisted living facility, and the other one wanted to join them. They called us in the first half of December, and there was a unit that was not supposed to become available as a 2-bedroom so they could reunite together in the same community. And the husband who was moving in second was starting to need more care. And what was happening is that the community, this was a CCRC community where there are large entry fees. That entry fee at the turn of the year, they were changing their pricing and there was high demand for these units. So the entry fee was going to go up by about $100,000. And it was the difference as to whether they could move into the same community or they were going to have to move the wife to a less expensive community for him to be able to move in with her and be able to afford it. So we had about 2 weeks to be able to get a bridge loan in place so that they could actually move into the community that he had been on a waiting list for a year and a half. And the timing worked out. We ended up closing it literally on December 31st.
Oh, wow.
They got their money. He was able to move in. And again, it changed everything for them. They were back together. They were in the community that they wanted to be in. They were, reunited. They were getting the care that they needed. And it's another $100,000 if you fast forward that now is in the family rather than paying it to the community. So it was a win situation. It was a rush transaction that had to happen. There was no question one way or another, but it was just really impactful. So that's one that really stuck with us.
Perfect. And lastly, any final words, anything that I should have asked you that I didn't ask yet?
No, I would say just some kind of last thoughts to put a button on it is plan ahead as much as possible. Don't wait for the crisis. Make sure you look at all the different options that may be available. Reverse mortgage is not the only option. Sometimes it's the right one, but many times it might not be.
Right.
And make sure that you engage with a full, proper financial team to make sure that the big decisions you're making, whether it be about a mortgage or selling your home or whatever it may be, that you're aware of all of the implications from everyone's perspective, because we all come at things from a different perspective. You're looking at things of, is now a good time to sell? I may be looking at things, what are the options to finance your way through this? Financial advisor may be looking at something completely different. And then the tax advisor comes in and says, well, if you do this, then you're going to have this other implication. You need all those people weighing in. So I'm a huge proponent of a full financial team. And that goes for seniors as well as even people who are just starting their careers and trying to make good decisions. So those are really the takeaways for me. It's just prepare in advance. Don't shortchange yourself on not paying for proper advice. It can be highly impactful. That goes way beyond what the actual cost of the advice is. So those are really the key takeaways for me.
Perfect. And how can people get in touch with you if they want to learn more about financing options or listen to your podcast?
Yeah, sure. So the podcast is called On the Mark. It's on all the streaming services. So if you search for my name, Mark Maimon, On the Mark, you'll find it. You can also go to our website. We have 2 different landing pages. One is for seniors themselves, which is seniorfinancingsolutions.com. And then we have another one that's for professionals that support seniors in different capacities. That one is financingforseniors.com. They end up at the same place, but there's some great resources, podcasts, YouTube videos, downloadable PDF flyers that talk about some of these topics. And we'll be creating some more instructional videos here real soon as well. But, go check it out, take a look, find some resources. And if you need connections to other professionals in different capacities, whether it be financial advisors or tax people or whatever it may be, estate planning attorneys. We have a great network of people that we have deep relationships with that we can engage with, if that's helpful.
Perfect. Mark, thank you so much for joining me today and making the world of senior finance a little less intimidating and a whole lot more strategic. Your ability to simplify complex lending solutions, especially for families navigating emotional transitions, is a real gift. And for those of you watching, if your loved one is considering senior living and you need to figure out what to do with their home, let's talk. Schedule a free consultation with me by clicking on the Calendly link located in the video description for this episode on YouTube. You can learn more about my services at www.simplifyseniortransitions.com. Have a quick question, DM me on Instagram at SoulByDale. And if you found this interview helpful, make sure to like, subscribe, and share this video with someone who might need this information. Thanks for tuning in. Thanks, Mark. One last time for being on the show.
Thank you, Dale. I appreciate the opportunity.
You're welcome. And for the rest of you, I'll see you all in the next episode of the Simplify Senior Transitions podcast.